You may well be asking yourselves, what exactly does the investment of my assets have to do with transferring my wealth, when the time comes? I'll answer this question in two parts. I think it goes without saying that how you invest and then manage your wealth whilst you're alive is obviously going to impact what assets are left over to your beneficiaries when you pass away. The type of asset that you leave is going to also impact the strategies that are available at that time for the transferring of the assets across to your beneficiaries. So what I'm talking about there is, if you've been investing in growth type assets, obviously there's going to be, or we hope there's going to be, capital gains tax issues because it means that they've done quite well. And then also, whether the assets are invested in fixed interest type of investments, where CGT issues aren't always there, but there is a trade-off which I'll talk about shortly. There are some misconceptions when it comes to retirement planning, and I'm just going to step you through a few of them here. The first one you can see here: I can protect my wealth and fund my retirement income needs by investing solely in fixed interest. Now, if you are in that fortunate position where you have accumulated a significant asset and happen to have a rather modest income need, then it's true that investing purely in fixed interest could be appropriate. But we have to say that in our experience on the majority of occasions, that's just not the case. Generally speaking, the income generated may not be sufficient to meet the income needs of the individual, which of course is going to force the sale of some investments along the way to fund those income needs. Just taking a very simple example, let's just say we've got $1 million invested purely in fixed interest investments. Those investments are paying interest of around 7.5%, so that's $75,000 a year. But the individual has an income need of $85,000 a year. So clearly that additional $10,000 on an annual basis needs to be funded from somewhere, and in most cases it's going to be funded via a reduction of the asset base. So you can start to see that over a longer period of time, you've got a diminishing asset base. You're still requiring the same amount of income, and in fact, due to inflationary effects, you're going to need more income. So you can really start to see that there's going to be an issue. Basically, that's just what I was talking about there. Having that 100% exposure to fixed interest investments without reinvesting that income is going to erode the capital. Now, the best way to really show you this is by way of an illustration. It's a very simple one. You can see here again, we've got our $1 million invested. We've got an income, in this instance, of $75,000. But you can see that line gradually increases. Now that's due to the impact of inflation, and that being that over time the cost of goods is going to rise. Now in this instance we've taken the simple average of 3% CPI, and basically the result is that over a 20 to 25 year period, that $1 million asset base is virtually exhausted. So you can start to see that if one of your long-term goals is to provide an asset base to your beneficiaries, this method of investing does not really work. I can invest my retirement savings in an industry or retail pension product to fund my income needs and still have a substantial asset to leave my beneficiaries. I have to say that we wish this was the case, but knowing that the way these types of products are structured, it's just not the case at all. Most of these pension products are unitised, and what that really means is you're purchasing units in a managed pension product. So if I take the example of, let's just take an industry super fund like a uni superannuation fund. You've spent your working life accumulating these assets in the accumulation balance, which may well have worked very well for you, but you've come to a time where you've decided to retire. In order to keep your investments in this under a uni super or any industry retail type product, you're going to be required to purchase these units to fund your living needs in retirement. Over time, pension products are designed to fund income needs from investment income, but also via the sale of these units. This isn't necessarily an issue in a rising market, but as we all know, markets don't always rise. And if we take the example of the last few years, there are retirees out there who have to continue to fund their income needs because they obviously have to continue to live, but that's been forcing the sale of assets in a falling market. And the sale of these units or these assets, they're not going to be able to return in value when the market comes back because they're essentially gone. So of course the result here is that the capital can really be reduced to zero upon an individual's life expectancy. A third misconception here is that investing in growth assets such as anything from Australian shares or property will not provide me with the income that I need. And this is a common misconception that we do see in the marketplace. Now, there's no doubt that having exposure to growth assets does create some greater volatility within a retirement plan. But if in the short term the cash flow is unchanged, in that the dividends and income, rental income from these growth assets remains unchanged, over the longer term, growth is going to really take care of itself. And I've got another table here I'd like to demonstrate that with. You can see here up on the screen we've got a parcel of blue chip Australian company shares purchased 10 years ago, $10,000 invested into each company. And at that point in time, and I'll stress that these are real figures, the total gross dividend of that basket of shares was 6.8%. So it's actually not that far below the long-term fixed interest average. So that's effectively cash income of $6,785. Moving forward 10 years to today, and we took these prices from the market today, we've got an increase in the value of the portfolio to $180,000. Now, of course, you'll all agree this would have looked even more attractive in November 2007. But what's most important is the gross dividend has risen to $13,740. So on the asset base of 180, that's providing a gross dividend yield of 7.6%. But if you take that dividend and mark it against the investment cost back in the year 2000, it actually results in a gross dividend percentage of 13.7%. Now, this is just on the basis that over time, as company profits have increased, they've increased their dividends along the way, which obviously provides a natural hedge to inflation as well. Now that we've moved, I suppose, past some of those misconceptions, investing into assets, into investments, is really about meeting the personal objectives of the individual. So what I'm saying here is that effectively everybody's different. Everybody's going to have unique objectives when it comes to following these following areas, whether it be short-term objectives, achieving a monthly income, perhaps taking an overseas annual holiday. Medium-term, individuals may want to buy a holiday home, perhaps a boat or a caravan. And then, of course, over a longer period, perhaps individuals would like to look at leaving assets to their beneficiaries. As such, we need to ensure that you have an investment strategy that you know is going to be able to achieve these goals, not one that you've had put in place for you. You're not quite sure whether or not it's actually going to achieve them. You need to know that it's going to achieve these goals on an ongoing basis. So how do you go about achieving a tailored strategy as such? I'm going to put up a few points here that we see as being extremely important in doing so. First of all, on most occasions, we see the establishment of a self-managed superannuation fund as being extremely relevant to a lot of people. The reason being, the members of that superannuation fund act as the trustees, and that essentially means that that they're responsible for all the investment decisions, all of the strategy decisions that go along the way. They remain in control of the strategy, which as was mentioned is going to be a living and breathing thing, and needs to remain flexible. So what we're saying there is that along the way, as circumstances change, the strategy is going to need to change, and you need to be in a vehicle that's going to allow you to do that. And typically we see a self-managed super fund as being able to achieve that objective. Of course, the appropriate mix of growth and fixed income investments can be selected to satisfy short-term income needs, but also generate that longer-term capital growth to achieve those longer-term goals that we just talked about. And we do prefer a direct investment. We do think it works best for our clients, and that's for a number of reasons. Accuracy in predicting cash flow is number one. If you just think about, if you break it down and you think about the direct investments such as property, you purchase a property, the rent is set and agreed upon ongoing, you know exactly what's going to be flowing into your bank account. When it comes to Australian shares, they publish and forecast their dividends, and as we've seen, they generally grow as their profits do over time. And in terms of fixed interest, obviously, the rates are set from the outset. You know, a term deposit's a perfect example of that. You know exactly what's flowing in to your bank account on a monthly basis. You know exactly what you're investing in. You know, when you're investing in a company like Woolworths, you know exactly what Woolworths do. BHP, direct property. It's very plain and vanilla, but it's easy to understand. Direct investment allows you to determine the appropriate mix of growth and fixed income and cash investments that allow you to meet your goals. And just finally, typically we find direct investment does provide lower management costs. Effectively, we're cutting out the layers of fees that are paid to middlemen. I thought I'd leave you with a slide in comparison to the first slide that I put up there. Looking back, we have again our initial investment balance of $1 million. We've got annual withdrawals of the $75,000, and we've got them indexed at 3% for inflation. Via the asset allocation up there of what we would term to be a balanced type investment approach, that's going to generate earnings of around about 9.3%. What we can see here is over, again, a 20 to 25 year period, rather than seeing that $1 million diminished effectively to nothing, on an earnings basis of 9.5%, we can see that $1 million effectively, you know, almost doubles in value over a 20 year period.